Well, hello and welcome to Bloomberg Quint. I'm Yash Upadhyay and we are at the sidelines of the Outlook 2020 event from Aditya, Birla, Sun Life, AMC. And joining me for a very special conversation are two gentlemen, A. Bala, who is the Managing Director and CEO, as well as Mr. Mahesh Patil, who's the CIO at Aditya, Birla, Sun Life Mutual Fund. So first of all, thank you so much for taking the time out and speaking to us. Sir, I'll start with asking you first. Well, there is bad news one after another. It started with the GDP forecast at 5% for FY20, and now with the CPI inflation number, which has come in way above the RBI mandate of 4% plus or minus 2%. What do you make of this data, and what are the concerns that you believe are there for the Indian economy at the current point?
See, definitely, I think the number what you're saying is it's a reflection of what you have seen. One, some of the growth slowdown that you have seen in the overall GDP point of view. Second, some of the price points have changed completely, especially in the last 2-3 months around the food inflation. Having said that, structurally, I think the economic growth I think should start seeing actually the pickup in the year 2020. We have seen this bottom of slowdown in terms of cycles, which again largely attributed by the credit cycle being weak. I think as we move forward in the 2020, I think credit cycle should come back. I think low interest rates should drive actually the demand for money, and therefore I think economic growth should come back. And second is recognizing this as a fact that the interest rates are the growth is slowing down. The government of India also has been trying to address some of these issues for the rate of growth to come back. I think inflation is more of cyclical in nature. I think food inflation will not remain for too high for too long. And it's more of cyclical nature. With the good monsoon being there, we may probably see the inflation, especially in food-related inflation, getting moderated. As long as the oil price doesn't spike beyond a point, I think we probably be able to live with rather move to the inflation close to about 4.5%.
All right, and sir, I'll ask you the next question. Obviously, we are expecting demand as well as the economy to revive from next year onwards, and in that case, obviously, it's very important to have a very healthy financial system, and financials as a pack includes your large corporate-facing banks as well as NBFCs. Which are the names where you're the most positive, or what do you make of the financial space in the current scenario, given how we are set up?
Yeah, so the financial sector went through a lot of pain last year because of the bank large NPA cycle and the problem in the NBFC sector, the liquidity problem in the NBFC sector. I think we are seeing easing of both of these two things. The large bank corporate NPA cycle is behind us. So we are seeing the gross NPAs slowly starting to come down. Slippages are coming down. And large corporate banks, I think you will see this year the credit cost will start to come down. Also, the NCLT resolutions, I think some of the large ones like SR Steel, means that there are significant recoveries. And as a result, we are seeing that for the corporate banks, especially the larger ones, and where we've seen there's also a management change. Right. Incrementally, you would see the slippages coming down, credit costs going down, ROE is improving, and that should see a revival. There is some amount of stress which is emerging incrementally in the SME space and the retail side, which has meant that the SMA1 and SMA2 book is slightly elevated levels. But that's slight cause of worry. But I think overall we think the economy recovers. I think we should not see these stress materializing into NPA. So clearly that segment of the market, the corporate banks, where we think there is still some potential for multiples to re-rate, can be a good space to be in. Within the NBFC space also there is definitely a consolidation happening. The tier 2 NBFCs which was starving to get capital fundraised from the system are slowly seeing things getting eased, especially for the banking sector. Mm-hmm. And companies, NBFC which have got very decent liability franchise and asset side are catering to the small ticket retail financing where there is a pricing power. We think they will do well going forward, and slowly the growth over there will start to improve. And within the broader financial services space, insurance is one sector which looks to be fairly growing steadily, securely because of increase in the penetration and more driven by distribution. Mm-hmm. That's another area which looks to be a good long-term play.
All right. And consumption obviously would be something that would also see a pickup as the economy also revives. Indians over the last 1 year have been spending very less, and should the economy revive, we're likely to see the consumption boost also to take place. What do you make of this, and which are the names where you are, which are the companies from the broader consumption space, which includes your consumer durables as well, where you are the most positive or the most bullish on?
So on the broader consumption, clearly there is a pressure point because of two things. One is the job creation has not been there, wealth effect, tightness of the credit markets, and rural consumption. So rural consumption, we expect it to start to revive over the next couple of quarters as rural farm incomes will start to improve. And I think overall low ticket consumptions, consumer discretionary, if you look at that's the segment which has got impacted, will start to pick up. And that space is also an area where we've seen the penetration levels are low. So as per capita income, that's a structural story to play out. And a lot of these sector and the consumer discretionary side, especially low ticket, unorganized sectors is still a larger play. So the shift from unorganized to organized will also mean material market share gains for the leading players. So these are companies in sectors like, say, for example, retailing, apparel, footwear, consumer durables, where we see a structural long-term trend, and the current slowdown is a good opportunity to look at some of these stocks which where we see structural long-term growth to remain intact.
All right. So one more important talking point that has been over the recent times is the market chatter around how the mid and small cap names are likely to start participating and the market breadth is likely to broaden. Which side of the argument are you on? Do you believe 2020 will be the year where we are likely to see a more broad-based, say, up move as far as the markets are concerned?
So I think if you look at analyze the reasons which cause this polarization in the market, we think some of these factors are normalizing, and given the sharp underperformance of the broader market vis-a-vis some of the top 10 names, there is room to believe that we should see normalization of that trade slowly playing out. Again, it all depends on how the domestic economy plays out, because a lot of these sectors and companies which are there in the broader market are linked to the domestic economy. So if our view is that domestic growth has bottomed out and we should see improvement, I think we should see that spreading out across companies. Having said that, it will be a very slow and gradual recovery, and the while the market will start to get broader, it will be very selective, both in the large cap space and in the mid cap space. We don't see across the board recovery, but clearly the polarization in the market will start to kind of normalize, and we see a broader movement in the market catch up in this calendar year.
All right. Sir, coming back to you, last year we had this expectation that the economy will soon start to move ahead from the shocks of Demon, GST, RERA, but then the NBFC liquidity crisis happened, and then because of that, again, the growth story was pegged behind by at least another 12 months or so. In 2020, while mostly everything is looking positive as of now, and there's expectation of the economy bottoming out and growing forward, what do you believe would be the joker in the pack, or something that could come in the way of this growth story in 2020?
I think this time around domestic related issues would get largely addressed. I think what you described last year was NBFC's crisis that happened. I think we'll probably see stability coming back both in the NBFC's market as well as the banking sectors, and the rates getting stabilized, therefore the credit cycle also could come back. I think what could potentially see that what you have seen in the recently the escalation, especially around Iran and US, and maybe it's a new thing which could come. Last year was driven by China-US trade war. Now, while that is seeing some kind of arrangement that is now falling in place, I think outcome on some of the recent attack probably we'll have to just see. And second, of course, what's an outcome was Mahesh mentioned in the presentation about how the US election outcome is going to play out.
Absolutely.
These are some of the things one doesn't know actually how it will play. Of course, we have still some time away for that.
Sure. And lastly, sir, we are in this all-important budget month. What do you have in terms of your experience over several years in the Indian markets that you believe the government needs to do in order to stimulate growth and get us back on the growth path? Any one of you can answer.
Yeah, so I think this time around there's a lot of expectation because of the slowdown in the economy, and while the government did in the earlier budget to do something on the supply side, tax cuts were done, corporate tax cut, I think there is need to get the confidence back and get the demand side stimulus is needed at this point in time to get us from this current low growth what we are witnessing.